Hey everyone, in this educational video, we're going to cover tax for freelancers and 1099s. Taxes are already complicated as they are, but what happens when you have a business that is subject to self-employment taxes, and what happens at the different entity levels? Things can get a little hairy, but we're going to break things down into basic tax principles and introduce some more advanced concepts later on. Just note, this is Tax 101, not 301, not 501. So for those asking complex questions, you might just want to hold those for our call. Let's hop right into it. Hi everyone, and welcome to this educational video on Tax 101 for freelancers and 1099 earners. So first of all, we again need to disclaim that a lot of this is provided to you as general overview information. We're really trying to give you a context on which to base our one-on-one time with and our call time with. So make sure that you're mindful that there are exceptions to all these rules and you may be that exception. We're going to cover basics of tax and accounting, as well as introducing some more advanced level concepts. But just note, again, this is Tax 101. The next one we will do will get a little more high level. But just to bring it all together, you know that what we've covered thus far has been accounting, minimum musts, as well as entity selection. So we're going to try and bring that all together into a tax overview. So on ramp, again, we cover tax accounting strategy. And our objective is to give you a framework that you can think through any investment or financial decision with basic tax and accounting information. Before I dive into that, I want to share our framework with you. And I think it's really important that we talk about how we think through rules and principles and what we're trying to do here. Because the way that we see it, there are really three principles that we're working through. And they're outlined here. They are the rules, which is really what you can and cannot do. They are the principles. Now, essentially, this is what you should or should not be doing. These aren't hard and fast, but these are general trends that matter. And then lastly, we have the vision. So your best version of success based on what you know or your context, meaning you have created a goal for yourself. How have you educated that goal as you've learned along the way? How have you educated that goal as you've learned about other types of freelancers, other 1099 earners, and how are you improving or editing that goal along the way? So I think it's super important to explain this because oftentimes when clients first come through the door, they're very focused on the rules component. What can I do? What can't I do? I heard this, I read this. That's important, but just as important is talking about the principles. And I'll give you an example where I came in on a tax issue for a larger company. They wanted me to look at 5 tax positions that they were taking, and I was really comfortable with 4 of them. On the 5th one, I remember sharing with the client, and it's kind of a funny moment. I'll explain why. I shared with the client, I said, look, I have an issue with number 5. And the client looks at me at the time, and he kind of gives me a smile, and he kind of has this, really, this is an issue? Explain to me why. So I go through, and he kind of lets me go through the motions. And he asked me, well, what do you think this is going to cost us at the end of the day? And I did the math, back of the envelope math, and I came out to a number around 10,000. And he looks at me dead in the eyes and he goes, how impactful do you think that number is for our business? And in that moment, I got it. It didn't mean anything for them at all. They were a multi-million-dollar company. Writing a $10,000 check to the government meant nothing to them. And that's when I learned sometimes the principles take over the rules. And in that case, the principle was materiality, which is if it's not a big issue, maybe we move on. And I want that for you as well, not just when it comes to tax, but also when it comes to accounting and setting up an entity and running your business is what are the principles at play that I'm focused on right now? And sometimes when you understand the relationship between rules and principles, you can decide for yourself which one takes precedent. To give you an example of when the reverse is true, you might have a situation where the principle of bigger is better gets interrupted by the rules. So for example, you might want to take on a 10th client and you may want to take on the expenses associated with that. And you might have a situation where you can scale up and pay a lot of tax, or you can defer that contract to the following year. What I mean by that is if you ran the numbers, and let's just say it's November, and you want the principle of more is better and revenue growth is all that matters is still in play, but you might see that taking on an additional client would result in being in a higher tax bracket. So in certain situations, sometimes the rules, the math behind what we're doing is going to give you some clarity on what you should not do. And we'll cover these more in detail. But again, when we tackle these examples, I'm always going to be asking, are we talking about the rule here? Or are we talking about the principle? And what matters more to you right now? And the last one's super important as well. And you might remember we started this program talking about what is your vision 12 months from now? 5 years from now. And as we're talking about that, I want to make sure that the rules and principles that we're juggling have to do with our larger vision. Otherwise, we're just becoming trivial. And I want to be very conscious of that as an accounting firm, we're not more focused on accounting than we are on your vision. So again, the objective here is to give you a framework using these 3 pillars and to work through the issues that come up along the way. And now that we've covered that, we can dive right into the basics of tax. So the first rule we start with is if you earn $400 on any platform, you have to report. The point I'm really making here is I don't want you to think you have an option of not reporting. It makes sense to get the clock rolling on your business if you plan to do this over a longer period of time. The other big consideration I want you to think of is that the biggest tax you'll probably deal with is self-employment tax. Oftentimes we have freelancers that are going from a W-2 role where half of that self-employment tax was taken care of by the employer, the other half was automatically withheld, and whatever hit their bank, they got to spend. And oftentimes when you start your own business, you still have that same perspective of it's in the bank, therefore it's mine. The truth is it's not. The truth is that when you calculate your taxes, maybe 70 cents on every dollar is yours because you've got to contemplate the percentage for tax. And practically over time, what happens? The $5,000-$10,000 in your bank doesn't end up having that math done on it. You think, okay, I've got $5,000 in the bank and that's mine. Well, when we file your taxes at the end of the year, you get surprised that there's a $3,000 tax bill and you only have $5,000 in the bank. So I want to be very aware and very conscious of what the tax liability is going to be and what the self-employment tax is, since it's going to be a big driver for your business. Accounting. From a tax perspective, the big thing I want our clients to be aware of is that you care about revenue, I care about net income. Revenue from our perspective is what I call a vanity metric. And of course, revenue is important. It drives the business. It keeps everything paid for. But from our perspective, sitting in a tax and accounting role, I just want to make sure that I know and that you know what your net profit is at all time, because that's what's going to drive the tax. The last point is that there may be additional regulations that are local to you or specific to your industry that we just want to keep on our radar. We're not going to get too deep into it, but for example, something very local would be New York City taxes. They have income taxes in that city. There's also gross receipts taxes. So if you're in the city of Los Angeles, everything you make top line gets taxed as well. So just be conscious that there are additional regulations that happen at the local level that might not be covered just by speaking from a federal perspective. I just want to recap on entities. By now, you should have seen and gone through our entity workshop. But just to recap, sole proprietors have a very basic filing requirement. You file as a part of your personal income tax return. That's your Form 1040. An LLC partnership is going to file its own Form 1065. That's its own tax return. You only file that when you have partners in your business. Be aware of that. But again, if you have an LLC and you have other individuals who have profit from the business and that have ownership in that business, they're going to be a partner in a partnership. Pretty basic stuff, but just repeating it so it's absolutely clear. If you have an LLC that's a single member LLC, then it's going to, like above, it's going to be taxed on your Form 1040 as a Schedule C. And the things to note here is that every entity we've talked about gets taxed at your personal rate. So if you make $100 through your partnership, it gets taxed at your personal federal income tax rate, plus in a service business, it's going to get that self-employment tax. So be aware of that. The next level down, we get to S corporations. S corporations have limited self-employment tax, but also require you to issue a W-2. So be very aware of that. Just because you have some kind of tax play you want to put into effect doesn't mean that you need to do an S Corp because you need to W-2 yourself. If you're W-2ing yourself, the $10,000 in profit you have, you're not going to have a clear benefit because you essentially had to pay yourself as a W-2 with additional administrative fees, what you just would have taken home as an LLC, right? So there is an administrative burden to being an S Corp, and that's the payroll. And it may not be worth it at the end of the day when you run the numbers of an LLC versus S Corporation unless you are at a certain profit level. The last type is a C corporation. Now, 99% of our clients are going to be one of the above, right? Sole proprietor through S corporation. It's not going to be your C corporation. Oftentimes where we've seen the C is if we have a very high net worth individual that's looking to bring their business income tax rate below their personal, right? So a C corporation has a 21% tax rate. So unless you're in the highest tax bracket without your freelance income, a C corporation probably does not make sense. Again, we can cover all this in more detail on our 101, and we also cover the entity overview in the educational video on selection. The basics recap on accounting, I'll just go through quickly since we've already covered it, but I will recommend to almost everyone that they get into some kind of accounting software, especially when you look at Wave, which is free. And typically for my freelancing clients, I'm generally recommending Wave, creating a separate bank account, even if it's a separate personal debit, and connecting that to accounting software, and just everything that hits that bank is going to be related to the business. The step ups from there are QuickBooks and Xero. So now we're having clients that are setting up agencies on Upwork that are scaling their business, that, have other contractors and folks that they need to pay out. Well, depending on what you want to see from a management perspective, it may make sense to get onto Wave and QuickBooks. And recall that there are two major viewpoints that we see accounting from. One is the managerial perspective. That's where you're looking at what costs are growing, how revenue's segmented. And then the other is the verifiability. So that's from an auditor perspective. And an auditor can be a tax authority like the IRS, but it could also be a bank that's verifying your income to give you a mortgage or what have you. So just note that you're managing two things. One is management. That's what you want to see, what numbers are meaningful for you. And then two, can you prove that the numbers in your accounting software are actually the numbers that hit your bank? And that's what reconciliation is. So super important to get those right. There's different ways to do it. You might think that we are going to push you into an upsell with accounting, but the truth is I'm completely happy if you have a DIY process around your bookkeeping and you have a bookkeeper do your reconciliation. The good news is we do that for our on-ramping clients anyway as part of the engagement. We have an initial reconciliation that we'll do, and then we will advise on the things to look for in our bookkeeping diagnostic, which we will do for you. So definitely take a look at our accounting overview if you want to recap on any of that, but it's super important that we relook at that from a tax perspective because it's coming into play right now. There are 4 minimum requirements that we need to manage to anytime we do book to tax adjustments. So when we look at your banking records from an IRS perspective or from an audit perspective, what we're trying to figure out is, do you have the 4 requirements to take a deduction? Those requirements are the date, the business purpose, the vendor, and the amount. What we're really trying to assess is, where do you keep your accounting information? If it's in bank statements, then we're going to take a look at that and say, okay, which of the 4 requirements have you met? Have you met the date? Yes, banking statements have the date. Do you have the business purpose? No, a business purpose is not recorded on the banking statement because that's interpretive, right? That's you categorizing what's happening in your books. Third is vendor, or where you purchased it. Yes, that is recorded. That description oftentimes ties back to the vendor, be it Office Depot, be it a subscription that you have like Dropbox. The vendor is going to be covered there. And then the amount. Of course, that's shown. That's the dollar figure. So really what you would do if you have no financial records, as we shared before, is use your banking statements to get 3 of the 4 requirements. And then you would be challenged to put down the business purpose. So those are all the minimum requirements. As we move into tax. And it's super important because, as you'll see with the homework, we are going to start categorizing our current expenses and projecting out what our profit and loss statement is going to look like. So it's super important that as you build that out, it's just going to be estimates, but think about, where do I keep my accounting records right now? Is it on a bank statement? If so, why not get onto accounting software like Wave or QuickBooks right now? And that way it'll be automated for the rest of the year and going forward. Back to the tax piece, the way that we report income and expenses for a sole proprietor or entity is going to differ. And we just have examples that we want to share with you. First one, the sole proprietor reports on a Schedule C. So what you're looking at here is a Schedule C, which is a single page. It has the tax categories. We've talked about these before. And your income and expenses flow through onto this page. This is where you show the business P&L. And then that net income at the bottom there flows onto your personal 1040. The next one you'll see is the partnership return. The partnership has different requirements as well as the shareholders that are members in the partnership. What I want you to notice here is that there is an income statement as well as a balance sheet, and there are additional forms, in fact, that you need to file, and that gets filed separately. So first you would file a partnership return, and there's different deadlines, and they're actually ahead of the personal deadlines. And from the partnership return, you get a piece of the pie reported on a K1, right? So if it's a 50-50 partnership, you're going to get a K1 showing 50% of the numbers, and then that gets filed with your personal. The take-home point is just partnership returns are an additional filing that is separate and more complicated than a single member LLC. The next one shown here is an S corporation return. Again, same concept applies. It is a separate entity tax return. The name of the S corporation as well as the tax ID show up. That is what's being filed. And then what gets provided to you is that same K1. So that piece of the pie that is yours is reported on its own sheet called the K1. And that K1 gets filed with your personal return. So it's still a flow through because it goes to you, but how it goes to you is different than if it was just a single member LLC or a sole proprietor, because you have to file a separate entity return. Last thing I'll get into here as we wrap up are the tax calculations. It's super important, especially as a freelancer 1099, that you get very, very clear on what your tax projection is. Going back to the first few slides I was sharing, I want you to be very aware of your net income. Revenue or your gross earnings, from my perspective, are important as an input, but as an output, they're not important when you calculate tax. Tax is based on your earnings less deductions. So what do? We calculate out the taxable profit that you have today. So if the year was over today, what taxable income would you have? Once we have that, we can then add on projections. So now we can look at that and say, okay, look, it looks like you're going to make 20,000 in net profit. Maybe you had 100 in earnings and you figured 80 deductions. It's usually the other way around though, right? It's usually 100 in earnings, 20 in expenses, okay, 80 in income. So if you're there today and you still have more contracts coming in, what do you think you're going to finish the year out at? Well, oftentimes clients don't do this on their own. So what we do is we do tax calculations to project out what earnings and expenses are going to be if all things hold constant. Maybe we make some adjustments and assumptions. Maybe we're going to close all of December to spend time with family. The point is we want to get pretty close to where you're going to be. And then we want to tell you, hey, look, if you do nothing else, your tax bill is going to be X amount of dollars. That's the ultimate figure that you're going to end up with. And that's what you can see in our tax liability calculator, which we're going to let you get your hands on. So the tax liability calculation is the end of the day result, but for our call, it will be the starting point. So what we're going to do next is we're going to take that tax calculation and we're going to think about what are ways that we can change this number. Are there investments we can make? Is there an entity selection that we need to make? How can we make the changes before the ink dries? And you can see here on this slide that we also cover the self-employment tax. Which entity you want is going to be based on self-employment tax considerations. What I mean by that specifically is for a freelancer or 1099, there is a point where an S corporation makes sense. And if you can see in this example, we have a business owner that has about 37 in operating profit and an associated about about $6,000 in self-employment tax. And the next year, they expect to scale and grow and have $220,000 in operating profit and an associated self-employment tax of $24,000. There's some assumptions going in here, but the point I want to drive home is that you could be a $220,000 operating profit business and you can get slapped with a $24,000 self-employment tax. But if you were an S Corp, what you could do is you could salary yourself the $36,000, $37,000. Your self-employment tax goes back down to that $5,600 and you effectively save $18,000. So there's $18,000 in savings, assuming a high level of operating profit for making an S Corp election. So those are the things that we want to get aware of and we want to dial in now before the end of the year. So wrapping up with questions. What you should be able to answer by now are the questions we're going to leave you with. And they're written in first person. So what did I decide to do about my accounting? What business structure do I want to use? And what is my taxable profit going to be by the end of the year? Those are the questions we're going to work on as we move into the next phase of this project. And there's some homework. So we're going to give you a tax liability calculator that we're going to ask you to fill out. As soon as you fill it out, mark the request as complete in the client portal. And as soon as that gets thrown over to us, we'll give it a review and move you on to next steps. We hope this was helpful and insightful. If you have any questions, please do not hesitate to reach out. We want to be available to you. We want you to work on this in the most effective way possible. And we want to connect with you about what those liability calculations are going to be while we still have time. Okay, thank you. And until next time.